Hey everybody, welcome to another episode of REISmartTalk. I have one of the best in the business with me today, special guest Casey Quinn with Accruity. Accruity is a tax strategy company. They are built to help you utilize the tax strategies inside of real estate to get that money back and reinvest it into your business. So Casey, if you want to start, kind of talk about Accruity for a second and, let's just walk into it.
Yeah, for sure, man. Right. So first off, appreciate you having me on, homie. Obviously, you and I have known each other and have created some successes inside of our own circles. So appreciate you having me on here and excited to add value to your listeners and everybody inside of your network and everything you have going on here. But yeah, man, we started Accruity about 3 years ago. And the reason we did that, right, is a full service tax and accounting shop focused on real estate investors and really maximizing their returns in their business, both from a bookkeeping and a financial reporting and a financial clarity perspective, more than anything. And then of course with that comes, once you have financial clarity, you're probably wasting way too much money, and your largest expense is your tax bill, right? If you're running a good company. And so myself, having been a CPA my entire career, then I moved into real estate investing, right? And I became pretty successful real estate investor, built a large real estate portfolio. I realized quickly that when I started to get into the rooms across the country and different masterminds, meeting folks like yourself, that there's a lot of really successful real estate investors out there that really didn't create success the way that I did, right? And the way that I did that was building a real estate portfolio, keeping more of my assets, right? Not a real estate investor that's doing a ton of fix and flipping, wholesaling, or buying and selling through the retail version, right? It was more buying real estate, fixing it, and keeping it as long as I can via the BRRRR method of real estate investment and value add. And then when I got in these rooms about 3 years ago, we realized oh my God, there's really successful real estate investors across this country that are giving the government significantly too much money. But not only are they giving the government way too much money, they actually have no idea what's really happening inside of their own businesses today. Don't know when to hire next. Don't know what they're actually making. Don't know where their money's going. So that's why we created Accruity. Again, we're up to about 150 total clients. And really, we're focused on real estate investors and helping them get the clarity and then not pay the government anymore, right? Like I always make the joke now when I'm on a keynote stage. There's two problems nobody could ever solve, right? Death and taxes. And I think we've officially been able to solve one of them. And maybe by the time we're in our late 80s, we'll solve the second one, right? With AI and healthcare and all the things happening to solve death. But we ain't solved that one yet, right, brother?
Yeah. I know the very first time I think we were down at Apex, or maybe it was one of Travis Wells' events, the first time I saw you speak. And I didn't know who you were at the time, so I really wasn't paying that much attention in the back of the room. I was kind of working on some of my projects and sitting in back there. And then it was like, wait a minute, he's talking taxes. That's something that I don't know that well. And then you leaned into the BRRRR method, and I was a BRRRR method guy prior to, but I didn't know my numbers. And by the end of your stage presence there, I literally was like sitting on the edge of my chair and took 3 pages of notes and was like, oh my God, I've been doing it wrong. Where's this guy been my whole life? Because I started with flipping, and then flipping led me into, I had surplus money. So then it led into buy and holds. Buy and holds led me into growing that portfolio, but I had no mentorship. So that's why I sat up and went, oh my God, this guy is incredible, and got me away from why I should be flipping into why I should be holding more properties. If you would talk through that strategy for our listeners.
Yeah, absolutely. Right. I mean, obviously the biggest difference between flipping and keeping the real estate is you sell it and you make a profit, where when you BRRRR model it, certainly there's a chance at what's called a cash out refinance, right, is the buzzwords, where on a cash out refinance, what happens is you ultimately spend less money than the banks are willing to lend you, right? Banks, DSCR lenders. And so, for example, we're in Pittsburgh. We just announced again the most affordable city in the country.
I think we're Pittsburgh.
Number 2. What's that?
I think we're number 2.
Yeah, you're top 5. I don't know. Probably number 2.
Yeah, very similar cities.
Yeah, so if you just do the math, I mean, we have a lending company out here. Obviously, we have a huge portfolio. The average retail price in Pittsburgh is $250,000. It's $150,000 below the national market. So the way this ultimately works is, let's say you buy a home for $100,000 and you put $50,000 in renovations into the property, and now you can go sell it for $250,000 less your selling costs. You might make $75,000, for example, right? Great. Now you're going to pay taxes on it. Let's say you do really well. You're going to pay 30% on that. You're going to pay $20-something thousand to the government, wasted money. That exact same example, what we do is what's called the cash out refinance strategy, where instead of selling it and making that net and paying taxes and losing all of it to the government, we keep the real estate asset. We go to the bank and say, bank, we have a $250,000 home. We have this company, they rented it, right? The third-party management company, you can do it in-house, whatever you want. We can go down that path if we need to. But hey, look, I have a $250,000 home. It's rented. The tenant's paying the bills. I want to keep it. Will you give me a loan? They say yes. A lot of times they're between 75 and 80% what's called loan to value. And so they're willing to lend you 75% or 80% of the value of the property as long as the tenant's paying the rent. And so in that case, right, let's just make numbers simple. They're willing to give you $200,000. So instead of selling it for $250,000 minus your selling expenses, you get a $200,000 loan. As we know, the tenant's paying it off every single month because they're paying your rent. And so you get less money short term, but you don't have to pay and waste to pay the government all of that. And if you do the math, of course, depending on the deal, where you're located, how well you performed, all of the things, what I could pretty much show you is that after year one, you've pretty much made the same amount of cash anyways once you're done paying your taxes. And now all of a sudden you're off to the races because you still have all of this equity. Going to build and raise and scale companies and own more real estate, guess what you need? Debt. Right? You need to be able to borrow on your assets. And guess what banks love? When you're worth more money. So keeping that asset is so valuable to be able to leverage and borrow more money, good borrowings in the future. And if you're going to make the same amount of money back over the course of 1 year anyways, why not keep the asset? The only real argument that anybody has ever given me is like, well, I got to be able to pay my bills, right? And so I agree with that. And so I always tell people, right, if you're flipping and you want to keep more assets and your goal is long-term wealth and passive income, let's get there, right? We'll get there by keeping more real estate. But if you're in a W-2 job and your goal is to replace your W-2 job with active income, well, we probably have to flip first because it's going to give you more money now to replace a W-2. Now we then start going into keeping a little bit more, right? So if you're going to do 10 deals a year at the beginning, I always say, look, like how much do you need to pay your bills? Let's do enough there. Maybe year one is 10 flips, no BRRRRs. But you better quickly moving into 9 flips, 1 BRRRR, 8 flips, 2 BRRRRs, 7 flips, 3 BRRRRs, and keep moving down that other path. And the answer really is just by simply learning a different method, giving up cash in your pocket today, right? Which is the hardest thing to do because we want to go out and we want to buy our Lambos and look cool and make sure we're buying our Starbucks and all the things. But give that up for a year. I promise you, you'll be eventually like me where you have this huge portfolio of passive income. You don't got to worry about those things anymore.
Right. And that was one of the big things that I know when you were on stage, you had a presentation where you compared the two. And at the time I leaned on flipping because I didn't like being a landlord. I'm not a good landlord. I'm too giving, I'll come over, change the light bulb, whatever. So that's why I hire that out now. I have somebody else take care of that. I'd rather pay that because it actually saves me more money. But when you came up and you showed that, I think it was like a $40,000 profit on a flip. And then you broke those numbers down to show what you're walking away with after taxes. And then you did the same exact thing inside of a BRRRR method. And 5 years down the road, it was like $114,000 in profit because of appreciation. So if we buy in a zone that is growing or is going to appreciate over the next 5 to 7 years, now you're gaining equity on that property, which also includes into the buying power. So buy and hold is just a phenomenal strategy to grow wealth. And I think too many people look at the beginning of it of, the hard part is getting past being a landlord and also fixing the property enough and then dealing with all of those hurdles at the beginning. So there's companies out there that do that for you to help you get through those hurdles. If you're like me, that I don't like those hurdles, and I still have a W-2 job.
And that's the thing that you need to really look at, right? You need to assess your own personal situation, understand what your highest and best use is and what you like, how much active income you need compared to what you're trying to get to passively, and then look at it from a retirement standpoint, right? It's physical, tangible assets that you can go leverage capital on. And so to your exact point, right, a lot of people become tired landlords and they sell and get out of the industry, or they never get it in the first place because they consider themselves a landlord, right? And they don't want to deal with tenants. They don't want to deal with maintenance issues. They don't want to deal with being a landlord. And so they forego the idea of becoming a really strong real estate investor and creating massive wealth for them and say, I'm just going to flip and create money. And they don't realize how much capital they're really wasting over time by paying the government and doing those things in a flip and not building real wealth that you can leverage. And to your point, the simple answer is understand what it is you're trying to do and what you're good at and how you make money and use that to your advantage, stay there, and then use this as an investment vehicle, not an active job, not an active business, right? And I tell everybody that, right? You don't have to be us. You don't have to have 1,200 doors under management today. Be running a management company, be entwined in that. You could simply give it to that business, right? And pay them. Yes, you're going to cut into your cash flow. Who cares? Right? Like if you have an active job and it's paying your bills and you're comfortable and you're happy and you're moving forward, growing your active W-2 job, making more income, but you don't need that passive income today, right? Let the asset do its thing. Treat it as a pure investment, just the same as if you put it in a 401k or if you put it in, Amazon stock, right? Treat it that way. You're not doing anything with Amazon stock, so don't do anything with the asset. Let somebody else do all of the work for you and pay them. By the way, just like you're paying a broker or you're paying somebody when you're investing in other things, treat it that way and it'll change the way, but it's mindset, right? It's understanding exactly what it is that you're trying to do and why. Now, I would tell you if you're trying to leave a W-2 job, if you're Scott and you hated REI Printman, which we know is not the case, because you're incredible there and we love you there, right? All of the things. But like if you're an active W-2 job and your only goal in life is to get out of it, well, cool. Maybe we're looking at it a little bit differently and maybe it's like now it's a pain game.
Right.
Pain of the W-2 job compared to the pain of dealing with a tenant you don't want to deal with. Like deal with the tenant over dealing with a W-2 job. But if like I'm happy here, keep this all the way down here. You don't need to deal with this stuff. Get rid of it, offload it, but don't stop investing. That's the key. You've got to continue to invest and build the wealth.
Yeah, I want to step into that a little bit of what it looks like, as a person has a W-2 job, say they make $300,000 a year and they have a surplus, and then now they want to cut that tax bill down. If they're paying 30% of that, that's $90,000 in taxes they're paying out every year. How do we stop that through real estate? How do we clean that up?
Yeah, great question, right? The first thing I would tell you is, number one, stop listening to people that don't know what they're talking about, and don't listen to a real estate investor that is pitching you on something. Make sure you talk to your CPA, make sure you talk to a tax strategist, a tax advisor, and make sure that they understand your situation before you go doing something dumb with a real estate investor. Because I can promise you in social media and everywhere else in the world, there is a lot of pitches that happen on a daily basis that aren't completely true. Right. And so the next thing I'll say is exactly around that, right? Like take all of this and caveat it by me understanding, like, I don't know your personal situation, listener. And so just like a lawyer who puts caveats or outs in everything we do, CPAs do the same thing. And I'm going to tell you, I'm doing the same thing right here, and I'm going to openly admit it. Oh, by the way, I'm a real estate investor, so I get it, right? When we're trying to raise big deals, we push depreciation benefits, as does everybody, especially this time of year. And by the way, depending on when this gets released, I have a deal going at the end of this year that's going to go out for investors to come in if they want to. Understand that your situation can be different depending on what you have going on. The very first thing that needs to happen is you either need to have passive income already to offset it, or you need to be a real estate professional based on the IRS code. So you either need to be active in real estate, right? There's 10 to 12 roles that create a real estate professional. We're not going to go through them all today. Literally pull out ChatGPT. What's a real estate professional? And you'll get that information, right? You have to be that, or you can only offset your gains from your real estate investments. Otherwise, you can offset all of the money you make, including your W-2. So if you're going to pay $90,000 in taxes for your W-2 job as a doctor, for instance, or as a dentist, or as whatever it is that you're doing, maybe you're in supply chain management at a corporation, okay? You have to be able to go get real estate professional status. The moment that you can get real estate professional status, okay, you can now offset active income with passive losses. What passive losses are is essentially depreciation is what I would tell you, right? If you have a real estate investment and let's say we go out and we buy a $500,000 piece of property today, okay? Now, what the government allows us to do is do what's called a cost segregation study. And so naturally, if you buy a property, what you have to do is depreciate it over 27 and a half years or 39 years if it's a warehouse, true commercial building and not residential. And so what that means is, we'll just keep math simple. Let's say we buy a building for $27. Normal depreciation, we're going to get $1 of expense every single year to offset our income. If you're a real estate professional, it can literally offset the money you made making wages as a supply chain expert at a corporation, okay? Well, guess what? Now, cost segregation is going to allow us to say, hey, the $27 building that we bought has floors, has a roof, has walls, has kitchen cabinets, has all of the things. Well, those useful lives in the IRS code are different than 27 and a half years. So in the $27 example, we're able to take $10 of it and say, hey, $10 of the $27 asset we purchased, right, is the roof. Okay, right. Cool. Well, roofs only need to be depreciated over, I don't know the exact code, it's either 5 or 7 years, to be honest, off the top of my head, I don't know. There's systems that we use for all of this, but let's say it's 5 years. Well, that $10 now is going to give me $2 a year in my first 5 years. So now I'm up to $3 instead of $1 in my depreciation, right? Offsetting my procurement W-2 income as a real estate professional. Guess what? That's less government taxes, 30% less off that we have to pay to our taxes if you're in a higher tax bracket. Now, let's say we go and buy $1 million building. Do the math, right?
Right.
On top of that, right, everyone always hears about bonus depreciation. It's the big thing we've been hearing about all year. As of January 19th, 2025, Mr. President Donald Trump, right, he put in bonus depreciation is back to 100%. And what that means is we can go out and everything that is allocated not to the building, but to all of the other things, the roof, the sidings, the cabinets, all of that example I just gave you, we could take all of it in the first year. So the entire allocation to the roof, we could take in the first year. And the really cool thing for us, like we BRRRR model invest, we do value add. The really cool thing is in construction, you already know where you're spending your money. So if you buy a home and you go renovate the kitchen, for example, right? And you spend 12 grand on brand new, beautiful cabinets. Guess what? We already know in our heads, we can cost seg it. We know that we can allocate all of that money to the cabinets. And we now know in our heads, bonus depreciation says we can take all of it in year one. So if we go spend 12 grand putting in new cabinets on a home that we are renovating as an investment property, guess what? We now have an additional $12,000 in expense that we can put on our tax return and write off against our income. And if we're a real estate professional, we can offset it against our active income. So if you made 100 grand, you now have made 88,000. And so now you're only paying taxes on 88,000 and not 100, which if you're in a 30% tax bracket, guess what? That's 30% of $12,000. That's a number that adds up extremely quickly. And so now you hear the people that are making the most amount of money across the country and why they don't pay taxes, right? Like I'm in that group. I haven't paid taxes in years because we take advantage of this by continuously buying real estate and offsetting all of the income that we've earned.
Yeah, that's a great example of that. I mean, I utilize that myself, and I saved myself, my tax bill went down $70,000 last year based off the knowledge I've learned from you. And in doing that, what am I doing with that 70K? Reinvesting it. So it's running back in to buy another house to cost seg for the next year and preparing my next year's taxes to where I'm at zero. And I'm utilizing the money that the government wants from me. I'm utilizing that to back and invest into me and my family and my kids and utilizing it how I want to spend it, as long as it's all legal and good.
I'll give you another perfect example, right? I'm buying a $3 million building at the end of this year. So in 2025, we estimate we're going to get roughly 40% from the purchase price in year one tax depreciation. So $3 million, right? You're looking at $1.2 million in expense that we can take in 2025 by buying an asset on December 30th of this year. And so $1.2 million off any active income that we've made. Right. And obviously you guys know, if you think about it, we bought it on the 30th. We didn't make any active income off of that deal. Right. So all of the $1.2 million is going to offset all of the money we've made this year on other active income, our business income, W-2 income, whatever it is, as long as you're a real estate professional.
Yeah, it's a phenomenal task. And if anybody watching this wants to catch up with Casey, there's going to be links in the bio to catch up with him and his team to walk through how they can better help you and your team become tax-free and work with you on cost segs and all of that. Teach you, they can work with your current CPA and help them with the real estate side of things, or they can take everything over for you. One more thing before we go that is, money. It's super important. How do we find these properties? How do we go to banks and get the money? One of the things that you talked about on stage is how to present yourself to the bank and how to get your financials in a line. And when you walk through that presentation, I was amazed at how anybody would ever tell you no, because you had your systems and processes so documented that I don't know how the bank would tell you no, because you look better than they do. Can you walk through that process, why it's so important?
Yeah. It's a very loaded question, right? But what I would tell you is everything in life is sales at the end of the day, right? It's relationship sales or transactional sales. But every day we wake up and we go to work, we go to the office, we go to a family outing, whatever we're doing, right? We're creating relationships, which is selling ourselves and our brand and our human and who it is that we are. And going to get money is no different, whether you're raising it from investors, you're asking partners to come in and split equity with you, or you're going to banks to leverage and borrow money. Same concept when you're going to buy a car, right? Can you get money to buy a car? Financing. right? It's incredibly important to make sure that when you're doing that, it looks professional. The same thing with curb appeal on a home, right? If you do a flip, we just talked about fixing and flipping, BRRRR model investing. Well, like, you got to understand, if you renovated the entire interior of the house and all of a sudden, though, you didn't touch the outside and like it looks like a war zone, you go up, well, probably it's going to take a big old chunk of the price off because you're walking into a war zone, not a beautifully flipped home. You get it, right? Well, you're no different in how you understand and how you're selling yourself to those banks. It's just done a little bit differently, right? Because what they care about is that you're a responsible, trustworthy borrower, and you, right, are going to be able to pay them back, period. That's what they care about, right? They're assessing the risk of the deal and of the human involved. So what we do is we make sure that we leave no stones unturned when we're trying to sell them us. And the biggest key here to everybody that needs to understand this is it's not about the loan originator. Certainly they are important, right? The human that you're connecting with and talking to when you start the deal process and you give them the information and you're going back and forth having those conversations. Their sales, their job is to do two things. One, sell you to use them, and two, sell their superiors on why you're the right person. Because, by the way, if you don't know this, they get paid when you do deals with them. And so how do we give them the tools to do their job better, to sell us to whoever's in charge of giving the approval on the loan, whether it's the credit manager, the chief credit officer, the chief lending officer, the board, right? When you're getting more loans, we're at the board level. Sometimes, right, I've had meetings with CEOs of large local banks. And my job is to sell them on why I'm a comfortable borrower, right? Why they should lend me money. That's important. So having a professional office for that reason, or meeting them at a very nice coffee shop, having the personal meetings, getting to know them and connect with them. Not everybody loves banker meetings, right? And we all just want to send it off and not care and hope it all gets done. Controlling that process incredibly well is so much more important than anything, because it takes money to make money. You have to leverage. So the other thing on top of that is, like, look, we understand that I'm not going to be able to have all of the meetings with the board when they're at the board level approving 7 loans in front of them. I'm one of 7. And who knows what side of the bed they're going to wake up on that day. And so how do I give them more tools to want to accept me if they don't even know who I am? So we create, obviously, deal spreadsheets, deal pamphlets so they understand the entire deal. But we also do the exact same thing for us. And so what I've always called it is a personal financial statement on a steroid, right? Which is probably what you really want me to get to here, which is, look, I've created a pitch deck that tells them everything they need to know and the entire thing about me, right? So not just the deal's a good deal and not just that I've been successful, right? Like, cool. No.
Yeah, they don't
We're
have
talking,
to
they know me, they know my bio, they know where I came from, they know my family, they see my kids on a photo when they're going to approve my loan. Why? Because it's sales. I'm a family man. They need to be able to see that I'm a family man, right? Not only see that, they see all of my assets. I have 52 bank accounts. They know how much money's in every single bank account. It literally shows it right on the pitch deck to them, right? Not only that, it knows the companies that I own. It knows my ownership in those companies. So they literally have the entire picture of everything about me. Guys, I'm telling you this, it's not even the most important thing that they have all of that. What is the most important thing is the sales process, right? Holy heck, does this guy have his shit together? He knows every single number inside of every single bank account, inside of every single asset he has. He knows his liabilities. He knows his companies. He knows all of his things inside and out. Who do I want to lend money to? The guy that knows every single thing going on inside of his entire business right here on this pitch deck? Or the guy that literally doesn't even know how much money he makes per month? Well, it's pretty obvious. And so creating that ability for them to see and understand why they should lend you money is so important. And it fundamentally goes all the way back to basic bookkeeping. And people take bookkeeping for granted and call it a necessary evil and all of the things, right? And then they go to get money and it's like 8 months behind on updating their books and records, but they have money in their bank account, so they're good. Well, no, what do you owe? Who do you owe it to? When do you owe it? What do you own? When do you have to pay off what you own, right? All of the things. What's your debt service coverage ratio? How much are you actually making above and beyond any debt that you have? All of those, right? Telling the financial story, putting it into a picture so that somebody can see, feel, and understand who it is that they're lending to. That's what's going to create your ability to get yeses and reduce your price of those costs significantly more than saying, look, I don't care about any of this. I'm going to go to Johnny the DSCR lender. I'm going to pay 3 points and I'm going to get a 7% loan, when right now you could pay a quarter of a point to your local bank and probably get a loan in the low 5s. Well, guess what? That's hundreds of thousands of dollars over the next 5 to 7 years that you're making a mistake, especially at scale, if you're not really dialing in the photo of how exactly it is that you look and really taking a clear financial picture. And the last thing I'll mention on this too, right, is just a simple fact of not only will it do all of those things for you, when you go to sleep at night every single night, you're going to feel really good because you're going to know that, hey, I've got to make this decision tomorrow because I know exactly what's happening in my financial picture. So I'm not worrying about my next bill, right? I'm not getting surprised with someone that I owe 10 grand to that I forgot about. All of those things, it creates the financial clarity that most important that you need. That's going to allow you to go out and borrow more money smartly in order to create more assets, to build more wealth, to be able to be the guy having a conversation with you on a cool podcast, right? Like that's what it's going to get you.
Right. And that's the thing is I really don't think, and I reflect back upon the mistakes I've made inside of my career, that people sit down and assess the profit that is created by having a good tax strategy and the profit that is generated by keeping good books. And, there's always that term of do what you're good at and then let somebody else do what you suck at. And in doing that, if somebody's going to pay a better attention or is better in that field, typically you're going to make money there or you're going to stop losing money. Any dollar lost that is saved is a dollar earned. With that thought process, if you don't have the right person in the right position take care of your books, whether it's you or a local accountant, you think you're saving a couple $100 a month in that aspect, you're actually probably losing a couple thousand. And people don't stop to look at that. I know I didn't. And I went to bed every night back in the early 2000s going, this is easy. And then 09 hit and then it wasn't. And I was not prepared for it. And those are mistakes I made in my life in tax strategy and business and all of that. And that's something you and your company, I've talked to a lot in the industry, and I don't know anybody that explains it as well as you do on stage, and also explains it as well as you do off stage. We've been in plenty of little small circles where you've been explaining certain things intricately to that person in their business, and you can just watch them all go, oh man, I've been doing it wrong this whole time. And that's the thing I love about you is you pour into everybody around you. You're one of the people that I like, know, and trust the most as far as tax strategy and in business. I would hand my kids over to you. That's how much trust I have with you and your family and your company. So I want everybody, if you've taken anything out of this, I want you guys to stop, like, and follow. And at that point, also chase Casey. Follow him on Instagram and on Facebook. Look up Accruity. Sit down and have a tax strategy session built specifically for you. No different than us here at REI Print Mill, where we'll sit down and walk you through direct mail marketing. He will walk you through your tax strategy and your business as that goes. There is a little bit of money with it. You will save in the long run, trust me. All right. I appreciate anything. Do you got anything else you want to add, Casey, as we close this out?
No, I appreciate you having me on, right? The last thing I'll just leave you with is think about it this way, right? Like what good accounting does, what good tax strategy does is let you play inside of the lines. But what it really does is imagine you're playing pool, right? It's hard to make cue shots. You got to really, really practice. But whenever they give you that little thingy, you can put your stick on it and it goes straight every single time. What's it? The bridge, right? Yeah. It's a lot easier, isn't it?
Right.
It's a lot easier with that thing. Basically called cheating. Well, having a good back office, having good accounting, and a good tax strategy in place is just like that. It's a cheat code, right? Mm-hmm. You don't have to make sure your hands are steady. You don't have to do that anymore. It's already done for you. And so your decisions are significantly easier, just like that pull shot is easier.
Yeah, and that's
the importance of the strong back office.
And I often equate that to people as walk the path that's lighted and paved. You're not going to walk through the darkness and walk through the woods and blaze your own trail and think you're going to reinvent the wheel.
Blaze your own trail in real estate investment, not in your back office, particularly if you're not good at it.
Right. Numbers don't lie, and they'll get you in trouble quick if they're not paid attention to. So, hey, man, I appreciate you having you on this episode of REI Smart Talk. If everybody likes, follows, and subscribes, I'd appreciate it. And then also do the same for Casey. Follow him. Find out more about Accruity. Find out more about yourself inside of your own tax strategy. So, hope everybody enjoyed this. Have a great day.
Thanks, Scott.